Hello and peace, everyone. Welcome to episode two of IFRS Masterclass podcast. In this particular session, we are going to dive deep into the lease term, which is one of the most contentious matters when deciding a lease schedule, because lease term can be slightly fuzzy, can be vague. So it's not always the start and end date that's written on the lease contract. Rather, it could be it could have a ton of options. For example, extension option, termination option, purchase options, and whether those options are reasonably certain to be exercised or not would define where the lease starts and where does it end. In addition to that, we have a non-cancelable period definition. What exactly is a non-cancelable period? And then we would also have to look at the um, enforceable period, which is also a tricky thing within IFRS 16. So what we have to look at is what exactly is the non-cancelable period. Whether what does it really mean? Whether a lessee cannot cancel the lease during that period, or the lessor cannot cancel the lease during that period. What does it mean to have an enforceable period? What does it? How does it apply to the leases contracts? And then how do we assess the options that lessees have, and how do we assess whether which option is reasonably certain to be exercised? And eventually we'll talk about when do we need to reassess our options. So all these things are very practical, very much related to real world contention that people have, accountants have. So let's try to dive straight into the matter. Give me a few minutes as I find search for the file that I saved in the folder. All right, so here we have our presented slides for IFRS 16 determining the lease term. And so the lease term is basically defined as a non-cancelable period for a contract plus any optional extension periods the lessee is reasonably certain to use, and any optional termination period they are reasonably certain not to use. The term officially begins on the commencement date, even if the first few months are rent-free. So rent-free period are also included in the lease term. A lease is only considered truly cancelable if both parties terminate it without a significant penalty. Otherwise, one-sided termination rights are treated differently depending on who holds them. So before we move forward, let me also go straight to IFRS 16 standard itself and read out the definition for lease term for you so that you get a better context of what's going on. Okay, so lease term is defined as the non-cancelable period for which the lessee has the right to use the underlying asset together with both of these two things. First, the periods covered by an option to extend the lease if the lessee is reasonably certain to exercise that option, and the periods covered by an option to terminate the lease if the lessee is reasonably certain to not to exercise that option. So let's say the lessee has an option to terminate the lease after 2 years, and the lessee is reasonably certain not to exercise that option, which means the lease is actually going to continue for, let's say, 3 years, which is the actual term of the lease. Then the non-cancelable period would be defined as 3 years and not 2 years, even though the lessee had the right to cancel the lease after 2 years. Why? Because lessee had an option, but it was reasonably certain not to be exercised. Similarly, if the lease was only 1 year before the lessee has an option to extend the lease, and then it could continue for 2 more years, uh, and it is reasonably certain that the lessee would exercise that option and extend the lease, then the lease term would be 3 years, not just 1 year, because the lessee is reasonably certain to exercise the option and carry the lease to the up till the next 3 years. Right? And remember, we're talking about non-cancelable period right here, not the lease term, right? Uh, I'm sorry. We are talking about non-cancelable period as defined within the lease term, which means that this non-cancelable period can be extended by the following periods to define how to make up the lease term. All right, so let's move to the next slide. So, what exactly is the core formula? There are some base terms, and there is a certain option. So you don't just look at the strict legal date of the contract as we just discussed. You have to look at the commercial reality. So if the tenant has an option to extend the lease, uh, as we talked about, let's say it's a 3 year, it's a 2 year lease, but it can be extended to 3 years. Then management must assess whether they are reasonably certain to exercise that option. Let's say to extend from 2 years to 3 years. Now, reasonably certain is a high hurdle. It means there is a strong economic incentive to stay or leave. For example, you've installed highly customized, expensive equipment that you cannot easily move. So let's say you have rented a shop of garments and you have entered the lease term of 2 years, and there's an option to extend for one additional year. Now, you might have redesigned that entire outlet to match your branding. You might have some goodwill in that place. People know that you are operating that place. And if you move from that place, you would have significant economic disincentives, and so it would be reasonably certain that you would not want to move from that place unless forced to do that. And if the lessor does not have the option to cancel the lease, and only you have it, and you have the option to extend it from 2 years to 3 years, then those 3 years would be included in the the lease term, even though the non-cancelable period was limited to 2 years. So here's another example, a very quick one. You sign a 5 year lease for a warehouse with an option to extend for another 3 years, right? So it's a 5 year lease, but you can extend it to up to 8 years. So you have heavily invested in custom racking systems that cost a fortune to relocate. So if you relocate the entire warehouse, you would have to do a lot of fixture and fittings there to make it work again, and so it would be very costly for you. Because it is economically punishing to leave, you are reasonably certain to extend. Your lease term for accounting purposes is 8 years and not 5 years, right? So we have learned two things here, that the option to extend the lease should be with the lessee, not with the lessor. Lessor's option essentially define the non I'm sorry, the lessor's option essentially define the enforceable period, right? And the entire lease can be can only be within the enforceable period. Let me give you more context to that. So let's say it's a 5 year lease, the same example, and the lessee can extend it for 3 years. But the lessor can terminate the lease after a total of 6 years, which means rather than extending the lease to 8 years, lessee has even though lessee has the option to extend the lease up to 8 years, the lessor can still terminate the lease after 6 years, which means the last 2 years are not even included in the enforceable period because the lessor can walk away without any penalty. by terminating the lease after 6 years. And in that case, the lease term would not be 5 years because the lessee can extend it, but the lease term would not even be 8 years because the lessee cannot extend beyond the lessor's option. And even though that option is not exercised, the existence of that option determine that the enforceable period is within the bounds of 6 years, and so the lease term would be 6 years, neither 5 nor 8. And the second thing we realize is that even when the option is with the lessee, uh, we have to look at certain context, which we have to look at the financial hurdles, financial constraints of that decision to come up with the final criteria of whether the option is reasonably certain to be exercised by the lessee or not. Give me a second to check if there we have any comments, any questions on LinkedIn or YouTube. All right, we only have two comments. Mr. Hamas Siddiqui, thank you so much for your kind comments. Just trying to make better content for our audience, and the hope is to repurpose this content, make this available on recorded basis on YouTube and other places. Wazir Khan, Assalamu alaikum wa alaikum salam. Wazir, thank you for your kind comment. And even if you have any questions regarding this, what I do is I uh, announce it, and I announce the option to ask that question pre-event, and within that event, I can provide the detailed answer to your questions. And I hope that would also make a really good content for shorts on YouTube and LinkedIn. That would be a good thing to have. So even if you have any questions, you can record yourself, send it to my wherever designated places, and then I can include you and feature you in the podcast and answer your question correctly. All right, let's talk about enforceability and mutual termination. So to figure out the non-cancellable period, you have to see if the contract is actually enforceable. That's what we talked about in the previous slide as well. So a lease is no longer considered enforceable if both the landlord and the tenant have the right to walk away at any time without permission and without a significant financial penalty. So let's say I can break the contract on a week notice without any penalty. In that case, the contract is not enforceable beyond the time when I have that option to walk away. On the other hand, if walking away triggers a massive penalty, the contract is still enforceable because the penalty economically forces the parties to stay. So here's a good example. A company rents a standard storage unit on a month-to-month basis. Both the company and the storage facility can cancel the agreement within 30 days notice and zero penalty. Now, the enforceable term is only 1 month at a time because neither party is locked in beyond that. So even though the lease term, the lease contract may be defined for 2 years, 3 years, 5 years, but if both the parties have this option to continue to just terminate the lease and walk away, then we do not have a binding agreement. We don't have a non-cancelable period where lessor cannot cancel the lease. And if lessee can cancel the lease, there's not a reasonable certainty that he would extend the lease, and therefore uh, the lease term would be limited to 1 month at a time, because they would have a 30-day period before which they can, after which they can terminate the lease. And so coming back to, let me try to reinforce this same example which I told you. If there's a 5 year lease, the lessee can extend it for another 3 years, but the lessor can terminate, but both the parties can terminate, or lessor can terminate it after 6 years, then this is not a non-cancelable period, because lessor can cancel it after 6 years, and therefore the enforceable period would be limited to 6 years. And so that's the concept. Okay, so again, to make it more clear, let's walk through the one-sided termination rights. So what happens if one party has the power to cancel the lease, and it depends on which party it is, if it's a lessor or if it's a lessee. So if the lessee has the right to terminate the lease, then this is the treated as a termination option, uh, which have to be assessed whether it's reasonably certain or not, right? But if the landlord has the option to terminate the lease, which means the tenant must include this period in their non-cancelable term, right? So, for example, if let's look at the quick examples we have here. You sign a 3 year office lease, the landlord has a special clause allowing them to terminate after year two if they sell the building, right? So we have a 3 year lease, but it can be terminated by the landlord after 2 years. So you are the tenant and you have the right to leave early. Your lease term is 3 years because you are locked in for full period unless the landlord decides otherwise. So it's the right with the landlord, but again, this last slide glitch in the example, because if the landlord has the right to cancel, in that case, the non-cancel period does not exist beyond 2 years. All right. Commencement and rent free. The lease term clock starts ticking on the commencement date. This is the exact day when the landlord hands over the key and makes the asset available for use. So landlord often offers rent-free period as an incentive. For example, if it's a 5 year lease, there might be a 6 month rent-free period. And so even though no cash changes hands, the free months are actively part of the lease term. And similarly, if there's a 5 year lease, after 2 years, there might be a 6 month rent holiday, and the rent payment might start after uh, 3.5 years, let's say. The lease would still span full 5 years. So the rent-free period do not, even at the start of the period, the lease, at the middle of the lease, or at the end of the lease, does not affect the lease term. So let's say the lease term, or the lessee has the right to control the asset for 5 years, but the rental has to be paid entirely by the end of 3 years. So since the end of 3 years, up until the end of 5 years, no rent is being paid, but the right to control the use of the asset is with the lessee. In that case, the lessee still has a lease for 5 years and not for 3 years. The lease term clock starts ticking at the commencement date, the exact day the landlord hands over the key and makes the asset available for use, right? Here's an example. You sign a 10-year lease for a retail storefront. The landlord gives you the first 6 months completely rent-free, so you can build out the store and set up your fixtures. Your lease term begins on day one when you get the access and the control of the asset, and the total lease term is full 10 years, not 9.5 years. The first 6 months is not exempt only because the rent was exempt, right? So the lease term includes the entire period. The lessee has the control over the asset. So this was a quick clarification presentation on what lease term is. Now I would like to deep dive into termination, assessment of options for the lessee. So if you have any questions so far, we have 17 people on LinkedIn. If you have any questions so far, feel free to ask. Thank you. Let me share the screen for the next slide, which is the assessing the lessee's options. All right. Just a quick recap. At the beginning of the lease commencement date, an entity must determine the lease term, right? And this includes the mandatory non-cancelable period plus the optional period the lessee is reasonably certain to exercise an extension or not exercise a termination option, right? So we talked about the way that we define the lease term include the non-cancelable period plus these options to either to terminate the lease or to extend the lease. Uh, so the question is, does the lease have an economic incentive to exercise the option, whether it's reasonably certain to be exercised? And to answer this, the entity must look at all the relevant facts and circumstances, predicting future conditions from the commencement date onwards. So here are some specific economic factors. And the first of them is contractual terms versus market rates, which is what rent is there, define the contract, and what rent is going to be after, let's say, any extension option or intermission option according to the market versus the contract. So if the financial terms of the optional period, for example, rent, contingent payments, or purchase options are significantly better than what the lessee could secure on the open market, there is a strong economic pull to take the option, right? If there's a significant benefit that the lessee is getting as compared to the market by exercising one option over the other, that particular option has a strong benefit, a strong incentive to be exercised. And so this should be considered when defining whether the lessee is reasonably certain to exercise that option. There might be conflicting positions. Let's say where, for example, a lessee has a 5-year lease and it's 3 years. After 3 years, it can extend the lease, but after 3 years, the lessee will have to pay 50% more of the rental. So after 3 years, the lease would become less attractive. And so would it be reasonably certain to exercise the option to extend the lease or to not terminate the lease? Well, we cannot say stand alone because we do not know what the market rates are and what the cost would be of relocating this entire shop or location to some other place. So the question is, what are the pros and cons of any particular decision that would be made in after a particular time period? So we have to weigh in all these factors, and one of those factors is the contractual terms versus market rates. If this is the only factor that we have to consider, and the contractual terms are way more favorable than the market rate, then we would extend the lease. But if the contractual terms are way less favorable and penalizing as compared to the market rates of rent, then there's a strong incentive to move. But we would also have to consider the cost of relocation and other disincentives. So here's an example. A tech company leases office space for 5 years with a 3-year extension at 10K a month. If projected market rate hits 18K a month by year 5, the lease has a massive incentive and is visibly certain to be extended. Absolutely. So if, for example, the market rates are expected to be much higher than the contractual rates, and obviously to add to this, there are costs of relocation, it would be way more reasonably certain for the lessee to extend the lease or to not terminate the lease after 3 years and extend it to 5 years if the lessee has an option, provided that he's getting all the benefits. The second factor that we need to consider is significant leasehold improvement, which is a part of the cost of relocation. So if a lessee sinks substantial capital into customizing or improving the lease asset, they need time to reap the economic benefits of that investment, right? So let's say I have a fixtures, I have a depreciation period of 10 years or 5 years, let's say, and I want to fully utilize those fixtures in a particular location. But if I relocate, I have to waste, let's say, 60 or 70% of all the fixtures because they cannot be refitted into a new location because of the size and the shape of the location or how that location would be utilized. In that case, there would be a significant leasehold improvement required into the new location. So here's a quick example. A clinic signs a 3-year lease and spends $250,000 installing lead lined walls for an X-ray machine. Because these improvements cannot be taken with them, the clinic is reasonably certain to exercise their 2-year extension to avoid losing that upfront investment, right? So lead lined walls are going to be very expensive to install, and if they want to relocate, they cannot take away the walls with them, and therefore they would have a compelling reason to stay unless there's some other compelling reason to leave, which means the extension option would be reasonably certain to be exercised in particular scenario of that clinic. Now let's look at the termination and the relocation costs. There might be termination penalties, there might be relocation costs of shifting one thing from the other. So sometimes the sheer cost and logistical nightmare of leaving creates an economic incentive to stay. This includes massive costs, negotiation costs for a new space, and termination penalties. Just to, even though we have in principle discussed this concept, let's quickly review the example here. A manufacturer leases heavy robotic arms. Dismantling and transporting new machines would cost $100,000 and halt production for 2 weeks. Because switching costs are prohibitively high, they are reasonably certain to extend. Now let's talk about the operational importance of the asset. If the asset is highly specialized, let's say we are not leasing out the location, we are leasing an asset and it's highly specialized, regulated, or located in a strategically irreplaceable spot, the lessee effectively has no suitable alternatives. A good example would be any lease where a mining company leases a specific parcel of land directly adjacent to their primary extraction site, right? So because this is literally no other land nearby, that can serve this purpose, they are reasonably certain to extend the lease up until the period they are mining in that location. So let's say they're expected to mine for the next 30 years. The lease is for 15 years. After 15 years, there's an extension option for the next 15 further years. Um, and if, let's say, there is no other alternative and the cost remains the same, the company would be reasonably certain to extend that option, extend the lease up to the next 15 more years, a total of 30 years, because there's no alternative. All right, let's talk about conditionality. If an option can only be exercised if certain targets are met, the entity must assess the likelihood of hitting those targets. So there could be condition after which the extension option or termination option may be exercisable by the lessee, and we have to look at whether those conditions would be um, fulfilled in the first place or not. So let's say a retailer has an option to extend their mall lease, but only if the gross annual sale exceeds $2 million, right? And this could be a lease term. This could be a lease arrangement when the, the the landlord might be charging based on a percentage of sales, which means there would be, in addition to fixed rental, there might be a variable rental where the landlord is getting a percentage of sales. And so the option to extend the lease is granted to the lessee only if the lessee's annual sales exceeds $2 million. Because if it does, the lessor will have a higher rental, because it would also be earning a percentage of the total sales in that particular scenario. So if historically data and projections show that they consistently hit $3 million, the condition is highly likely to be met, and the extension option must be evaluated as usual, right? So if the condition is highly likely to be met, then the option to terminate the lease would be considered based on all the other factors that the lessee have, and this conditionality would not become a hard barrier into the lease into assessing the optionality of the lease term, and not a hard barrier onto where the lease term ends, because even though the conditionality exists, we are highly likely that those conditions would be met, and the lessee would have the option to terminate or extend the lease as usual after that particular period, because those conditions would be met. So beyond these specific factors, the standard dictates three additional logical rules for assessing certainty, known as special rules and contextual evidence. We'll talk about them in this section. So first of all, we have guaranteed minimum returns. So the concept is sometimes leases are structured so that the lessee guarantees the lessor a specific amount of money, regardless of whether they stay or terminate early, for example, via heavy termination penalty or residual value guarantee. So if the lessee has to pay the money either way, the standard requires the entity to assume the lessee will stay to get the use out of the asset they are paying for. So even though uh, there are two options, and the option to extend the lease, option to terminate the lease have a similar cost as compared to extending the lease, and so therefore you would assume that the lease would be extended. This is a particular para in the IFRS, and I would like to read it out for you as well. So under IFRS 16 B38, which is a para for application guidance, it says an option to extend or terminate the lease may be combined with one or more other contractual features, for example, a residual value guarantee, such that the lessee guarantees the lessor a minimum or fixed cash return that is substantially the same regardless of whether the option is exercised. So let's say if it's exercised, it will have to provide a higher residual value guarantee. If it's not exercised, it might have to skip it or provide a lower residual value guarantee. So in such cases, fixed an entity shall assume that lease is reasonably certain to be exercised, uh, and the lessee is reasonably certain to exercise the option or not to exercise the option to terminate the lease. But this particular guidance has to be read um, along with the guidance regarding in substance fixed payments, which we'll discuss later on. But the general principle is that the overall economic return to the lessor remains the same whether it's exercised or not. In that case, lessee is being penalized to take the option to terminate a lease, and therefore um, it should be assumed or should be considered reasonably certain that the lease will be extended. Now let's talk about the short lease principle, as we call it, in paragraph B39. The shorter the initial non-cancelable lease term, the higher the likelihood of extension. Which means, if let's say the initial term is, let's say, only 1 year or 2 year, and the total contract period is 5 years, then there's there's high probability of extending the lease term, simply because the initial period was very short, and when the entire contract is negotiated for a longer term, uh, or has a psychological understanding of a longer term lease, then it is likely to be extended. So the shorter the lease term, the shorter the non-cancelable period, the higher the likelihood of extension. The fixed cost of finding, securing, and installing a replacement asset hurt disproportionately more if it's spread over a very short period of time, right? So the very fact that in most businesses, the cost of changing the asset or the cost of relocating is significantly higher, and therefore, because of that cost, if the lease period is too small, there's a high probability of exercise of an extension option, or high probability of not exercising a termination option by a lessee. Here's a good example. A company signed a 6-month lease for server racks with a 6-month extension option. Data migration costs $15,000. It makes no economic sense to endure a $15,000 migration every 6 months, making extension highly likely. Um, and finally, we have past practices and historical behavior. So when assessing whether the lessee would extend the lease, we also have to look at the uh, intention of the lessee, and which will be predicted by its past behavior. A company's own historical data is strong evidence for its future intentions, provided the underlying economic reasons for that behavior remain consistent. So we cannot judge the intention independent of the economic realities of that particular lease contract. So, for example, a logistics firm strictly retires delivery trucks after 5 years. They sign a 3-year lease term on new trucks with a 1-year extension options. Given their rigid 5-year cycle, it is reasonably certain that they will exercise both 1-year extensions. Because they have a past practice of always retiring a truck after 5 years, which means they have a strong, strict policy of doing that, which means they are reasonably certain to extend the lease for the next 1-year extension options. Great. So now is the time to also discuss one specific question that we received on our LinkedIn post. Let me try to find it where it is. Louis, Saqib Khan, sir, how to get your IFRS Rise book. Saqib, this is a contentious matter for me as well, because I had received around 10,000 requests to send the DMs to people who have requested the book. I am uh, trying to make up to the request. I'm trying to continue DMing people to reach more and more people who have requested the book. But the limitation that we have is on the LinkedIn profile, on the LinkedIn um, DMs, you cannot reach more than a particular number of people after in a particular day, and therefore this is taking a very long time. You can simply DM me. I will try to reply you on priority. Uh, Second, Louis said, "Would you mind to slow down a bit?" Lisa, I'll truly try to slow down. This is a constant struggle of trying to slowing down, which should be, you know, good by the end of 2 or 3 episodes, as I try to, match this pace. People understand. Umar Mustafa, great inspiration from Nigeria. Thank you, Umar, for your kind comments. Let's move on to the very specific question that we received on our profile. I believe we were disconnected. Apologies for the interruption. Let's continue with the question that we are talking about. All right, we have a question here from Mr. Taha Shabir, and the question goes like this: how about a company operating several retail outlets spread across the country on lease? The lease is renewable on a yearly basis. However, no condition is present in the agreement to renew except providing a notice 1 month before. Can this be scoped out of lease under IFRS 16? Right. So first of all, let's address this part of this query, which is a very practical concern, and many people have this in profession. So under IFRS 16, scoping is not based on the duration of the lease term. It's based on whether the lessee has the right to direct the control of the asset, right? And when we talk about the right to control the asset, it's based on two significant factors: the right to direct the use of the asset, or the right to obtain and to the right to obtain substantially all of the benefits from that asset during that period of use. So even though the lease might be 1 month, it might fall under the low value item or the shorter duration, shouldn't lower than shorter than 12-month duration exemption, which means the lease would not have to be recognized as a financial liability in the lessee's books, but it will still be treated as an operating lease under IFRS 16. So it would not be scoped out of IFRS 16. It would be under IFRS 16, but it would be eligible for the exemption to be treated as a financial lease or as a financial liability. Secondly, when we talk about the extension options, we have to see whether there is significant cost of relocation. And if there is significant cost of relocation, then the lessee has a strong incentive to continue those retail outlets, because let's say those retail outlets might have their goodwill bind with the location. People would know where those retail outlets are. They would want to visit those locations. Then there might be fixtures and fittings inside those retail outlets. So if you shift the retail outlet every month, it's impossible to do that. So it makes no economic sense for the lessee to shift their retail outlets every month, and therefore to incur more costs on fixtures and fittings every month. Similarly, it makes no sense to bear the relocation cost of transferring all the assets, all the inventory from one location to the other, and therefore it's financially punitive for the lessee to be able to not extend the lease every month. Now, the question that we have here is whether this period is enforceable or not. So, whether the lessor can, on any day, say, get out of my location and you cannot continue using my location. And if the lessor can do that, then it's not an enforceable period, because lessor can do that without any penalty, and therefore the lease term cannot extend beyond whatever uh, boundary the lessor has for saying for walking out of the lease without any significant penalty. But if that option does not rest with the lessor, then all of these 1 month renewal options lie with the lessee, which means that the lessee exercises these options. Uh, he would be able to continue lease for 1 year or 2 years, 3 years, and to whatever extent the lessee has reasonable certainty of extending the lease, that period would be considered the lease term, right? Which means if, let's say, today, standing on let's say 31st March, we know that the lease would be extended without any reasonable without any doubt up till the next 2 years, then the next 2 years would be within the lease term, which means it will be treated as a finance lease for the next 2 years. But we have to be very cautious of what we are, how we are assessing the reasonable certainty. So And the general rule is that the further you go into the future, the less certain you are. We are not certain about the future. We're not certain about our economic conditions. We're not certain about whether the business would continue as a going concern for the next 10 years or 20 years or not. And so the just like we had, if the other extreme, where if the lesser the lease term, the less likely, the more likely it is to be extended. And similarly, we have another common sense rule that the further we go into the future, the less certain we are about what we would do. And therefore, we have to strike a balance of 2 or 3 or 5 years, even if the economic sense is compelling for the lessee. All right, now let's move on to the next part, or the final part of the puzzle, which is reassessing the lease term, which would make it more clear about when and how to reassess the lease term. All right, so now we have the final part, which is once we have decided the lease term, once we have assessed the options for the lessee, now we have defined the lease term based on all the assessment of what's reasonable to be excised and what's not reasonable to be excised, and we are now continuing with the lease. In the middle lease, when do we reassess the options that the lessee have? When do we reassess whether the options that we assessed at the commencement of the lease need to be reassessed, and whether the lease term need to be redefined? And if that happens, that would be considered a reassessment and not a modification. So have a look at this. When a company initially signs a lease, it makes an educated guess about how long it will keep the asset, assessing extension or termination options. However, business environments are dynamic. So the accounting standard dictates two-step logical flow for handling any changes, which is reassessment of the options, and then, if required, revision of the lease term, and that would completely change the lease liability and lease asset. So, what should trigger the reassessment? A lessee cannot just change its mind about a lease term on a whim, which means it's not purely intentional, right? So, if the intention has changed, if a lessee, let's say if a lessee says, I initially intended to terminate the lease after 2 years and did not intend to continue the lease for the next 5 years, and now my intention has changed after 1 year, and therefore I now intend to extend the lease and not terminate the lease after 2 years. And so the remaining lease term would increase from 1 year to 4 years, because after 1 year we have 1 year period and then 4 more years. And so a lessee instead must formally assess options only when a specific trigger occurs. So what it should trigger the reassessment? Now, this trigger must meet the three criteria. It should be a significant event or a significant change in circumstances, right? It cannot be a pure intention change. It cannot be a pure desire change. There should be a significant event or a significant change in circumstances. Extension should be within control of the lessee. For example, general market rate fluctuations don't trigger this, and the lessee does not control the broader market, and it directly affects the lessee's certainty regarding the option. So let's say a plan has changed, or restructuring has been planned, and that would define whether something would be extended or not, and it directly affects whether the lessee is going to be reasonably certain about exercising an option or not exercising that option. So here's our simple examples. Let's say it could be an unanticipated improvements. So major upgrades made to the property not planned on day one. To get the financial benefit, they will likely need to stay longer, right? So if you had leased a hospital building for 10 years and you had an extension option to extend it for 20 years, at the start of the lease, you were not certain whether you would extend it to 20 years. And also, you did not have any incentive because all the costs you had incurred, all the fixture and fittings you had implanted on day one would be fully depreciated by the end of year 10. But what happens is the assets or the fixtures depreciate a bit faster because the hospital utilization was much stronger. People demand was more. There were more patients, and so the hospital decided to improve the entire building after the end of 8 years. Now, if the hospital improves the building after 8 years, then the hospital would not want to the lease to end after 2 more years. Rather, it will use an extension option to further extend the lease for next 12 years, which means 10 more years. And therefore, that particular improvement, which was not planned on day one and happened after 8 years, would completely change the situation, would be a reassessment trigger, and would redefine what lease term is. And because the lessee would be reasonably certain to exercise the extension option after 10 years, or in case after or 2 years after the improvements. Here's a quick example to make it more clear. A retail brand plans to leave after a 3 year lease. In year two, they unexpectedly invest $500,000 in custom marble floors. So now they have updated their retail outlet. Now, this particular change might be unplanned for a variety of reasons. One reason could be, for example, that the utilization of the retail outlet or the supply of customers is more than they expected, and so they want this to be a better outlet. Or there could be more competition in the location, and they want it to upgrade their look and feel to come up with to compete in this scenario. Or they may have rebranded themselves, changed their brand positioning, and they might want to upgrade their retail outlets. So a variety of reasons that are within the control of the lessee can change the situation, and that could determine or that could dictate whether the lessee is reasonably certain to exercise an option or not. Now, abandoning this investment makes no sense. This triggers a reassessment, making them reasonably certain to take this 5 year extension. Another reason could be significant customization. So, for example, altering the underlying asset specifically for their own use and replacing it becomes highly impracticable in principle, or conceptually this is similar to unanticipated improvements. This is also kind of improvement or modification to or the customization to an asset, underlying asset that has been leased by the lessee. And if they make that particular investment, they would want to recover it. And if they have an option to extend it and the lessor cannot walk away without penalty, they would invest in it and they would extend it. A good example is a company leases delivery vans for 2 years. Halfway through, they suddenly weld expensive custom refrigeration units into the vans for a new contract. This massive customization strongly motivates them to extend the lease rather than rip the units out, right? So their customers wanted refrigeration in their vans. They installed it, and once they installed it, they now have a compelling incentive to extend the lease beyond the initial option they had. So if they had initially assessed the lease um, to end in 2 years, and now after 1.5 year they've installed this and they have an extension option to extend it for 3 more years. The original lease term would now not be 2 years but 5 years, and after the extension it would be 3.5 years. And so this is how the reassessment triggers can change whether the lease term would be reassessed or not. Now, once we have reassessed, we have to revise the lease term. Uh, so when phase one is about a change in intentions and economic incentives, phase two is about hard contractual facts. So according to paragraph 21, the entity must revise the actual lease term on its balance sheet when there's a change in the non-cancelable period. This happens when an option is formally acted upon, or when an option is ignored, or when an option is legally forced, or when an option is locked. So essentially, when the option no longer remains effective, the lease term would be revised. To make it very clear, let me also read out the para first and then give you examples for each particular point. So according to IFRS 16, paragraph 21, an entity shall revise the lease term if there is a change in non-cancelable period of a lease. Remember, the extension options were outside the non-cancelable periods and within the definition of the lease term. Right now, we are saying that the lease term must be revised if the non-cancelable period itself changes. So, for example, the non-cancelable period of a lease will change if these four things happen. The first thing is the lessee exercises an option not previously included in the entity's determination of the lease term. So even though the lease term had an option to exercise the option to extend the lease after, let's say, 2 years for the next 5 years, but in the initial recognition on the commencement date, we had assessed that this option is not reasonably certain to be exercised. But after the end of 2 years, let's say it is exercised. Now we have no option but to extend the lease term, right? And to look at the example, let's look at 21A exercising option. A company previously determined it would not be a 3-year warehouse extension. At the end of the term, they sign the paperwork to stay. The non-cancelable period has legally expanded. The term is revised to include those 3 years. Now, let's move to part B, which is in the exact words of the para. The lessee does not exercise an option previously included in the entity's determination of the lease term, which is very straightforward. So initially, the entity did not determine that the lessee initially determined that the option would be exercised. Let's say in a case where we were talking about annual or monthly renewal, and so if it was reasonably certain to be exercised for the next 3 years, and after 2 years the lessee chooses not to exercise that option, then the lease term would end where the option is not exercised. To look at a very specific example here, a restaurant signs a 10-year lease with a 5-year break clause. Originally, they were certain to stay 10 years. In year 4, they formally served notice to terminate at year 5. The lease term is immediately revised down from 10 years to 5 years. This is because the option has now been exercised, or the option to extend the lease has not been exercised. Let's move to part C here, which is an event occurs that contractually obliges the lessee to exercise an option not previously included in the entity determination of the lease term, which means even though the lessee has not exercised the option, but it has now been obliged to exercise the option, and this exercise of option was not included in the entity's determination of the lease term. So let's say contract states if equipment logs 10,000 hours, more than 10,000 hours, lease automatically extend by 2 years. During year 3, the meter crosses 10,000 hours, the lessee is now contractually obliged to the extension, triggering the immediate revision. So if this particular lessee uh, had initially assessed the lease term to be 2 years and had not assessed that it would use the extension option, because he is now contractually obliged to extend the lease because he has used the machine more pervasively than he had imagined. Therefore, the lease would be extended, and so the lease term would be updated. Final is the opposite of the same case, which is an event occurs that contractually prohibits the lessee from exercising an option previously included in the anti-determination of the lease term. So in this case, initially, uh, the lessee had assessed that he would be reasonably certain to exercise a particular option, but after a particular event, he is contractually prohibited from exercising an option, and therefore his lease term would now have to be revised. A good example is a lease has a 5-year extension option if rent is never late. So the company plans to extend in year two. Banking error causes a late payment, permanently revoking the option. It's slightly unrealistic for contracts to be defined this way, but there might be payment issues that could cause such a trigger. And so the non-cancelable period shrinks back to the initial term. And so this is how we reassess the options and how we reassess or redefine the lease term after once this has been decided. So I hope this was a valuable session, uh, session packed with all the nuances, all the practical guidance, all the practical varieties that you could encounter in real world scenario. And we also try to make it rich in examples to help you better understand each requirement in each context easily. And so that is pretty much it, I believe. Uh, so in the next episode, we'll talk about a different aspect within IFRS 16. So we'll continue this deep dive in IFRS 16, and all these slides that you saw, we would gradually release them on my profile. So if you're not already following the profile, make sure to follow. And when you get these posts, to make sure to engage with them, comment and share, ask questions. Because once we have these questions, I'll try to include those questions within my podcast and address your specific questions just like we did today. So thank you for joining. It was a great pleasure to host this episode 2. Looking forward to continuing this with the same spirit. Have a great day. Peace.